Okay, can you see the screen that I share?
Yes, sir,
Nampak,
I can
sir.
see.
Okay, we have first approach. There is top-down approach where OCF equal to quantity. Okay, quantity is the number of unit produced. Okay, for a year, for a year, for 1 year, quantity produced for 1 year. Okay, and then times the price. Okay, P stands for selling price. Okay, selling price per unit. Okay, P is selling price per unit, and then minus VC. VC the variable cost. Okay, variable cost per unit. So this one is per unit. Okay, Q is total unit produced for a year. Okay, and then you minus fixed cost. This fixed cost is for 1 year. Total fixed cost for 1 year. Okay, and then minus depreciation. Uh, Depreciation is for 1 year. Okay, and then times 1 minus tax rate. Okay, tax rate. You know, if 30% mean you have to minus 0.3 lah. Okay, and then lastly you plus depreciation. Okay, same amount as this. Okay, and then second approach we have bottom up. This is the most simplest method, but rarely or seldomly asked in the question. But if there is, you can use this method or this approach. Okay, for bottom up, OCF equal to net income or earning after tax, okay, plus depreciation. Okay, approach 3, tax shield approach. Okay, tax shield approach. This approach is quite similar or the same with approach 1. Okay, time P minus VC minus FC. Okay, this part is the same. Okay, the difference is on this part. For top down, you minus depreciation here, but for tax shield, you don't have to minus depreciation. Okay, you just straight away you time 1 minus tax. Okay, and then lastly you plus in bracket depreciation time tax rate. That's the difference. Okay, here and here. But if you use any of this method or approach, it will give you the same answer. Okay, so in the question, okay, you can use the top down or text sheet. Okay, because it will give you the same answer. Okay, and number 4 we have cost cut cost cutting or cost saving proposal. Okay, this one of CF equal to before tax cost saving. Okay, this one will be given in the question. Okay, it will mention cost saving, but you have to take before tax. Okay, and then you times 1 minus tax. Okay, okay, and then lastly plus depreciation time. tax rate. Okay, for depreciation in the formula, okay, we will use this formula to calculate the depreciation. Okay, we're just using straight line method. Okay, where this is annual depreciation. Okay, equal to cost of asset. Okay, cost of asset divided by how many years of the asset life. Okay. So far, any question? Hello?
No, sir.
Okay, sir.
Dengar? Saya cakap ni?
Dengar.
Dengar, sir.
Okay. And then we have, okay. Okay, thank you. Okay, now we have after tax service value. Okay. Or ATSB. Okay, ATSB is the net proceed, okay, received at the end of the project when the project is ended. Okay, the company can dispose or can sell the net asset, the fixed asset, and get some money from the asset disposal or fixed asset sale. Okay, so this one also have to be included in the calculation of the cash flow. Okay, but we have to take after tax. Okay, for example, if the company sell the fixed asset at the end of project 50,000, okay, that is before tax. So you have to, that is before tax or pre-tax value. And then company have to calculate after tax, where we just multiply with 1 minus tax, okay, to get the after tax service value or ATSB. Okay, another important point or item in calculation of cash flow, okay, you have to take into account net working capital. Okay, net working capital is the difference between current asset and current liability. Okay, in the question we mentioned initial MWC. Okay, initial MWC is referred to MWC for year zero. Okay, year zero is where the company start the project. Okay, start the project. Okay, and then you have to be careful because there is a term that will differentiate how we um, treat the MWC. Okay, if in the question it mentioned MWC is required, okay, mean there is addition. Okay, addition where you have to minus first at year zero. Okay, and at the end of the project, we will plus back. Okay, for example, in the question it mentioned initial net working capital is 50,000 required. Okay, so for year zero, okay, when they start the project, we will minus the 50,000 first. Okay, and then at the end of the project life, okay, when the project finish, we will plus back the amount. Okay. Or if the question mentioned NW fee is reduced, okay, mean there is reduction. Okay, reduction or decrease. Okay, if there is reduced, mean at year 0 when the start the project, we will plus first. Okay, we will plus first the amount. Okay, and then at the end of the project, okay, when the project ended, we minus the amount back. Okay. Okay. So first you have to calculate the OCF using this method or approach. Okay, and then you have to prepare the cash flow table. Okay, cash flow table, and to do some adjustment. Okay, this adjustment refers to ATSBM and WC. Okay, this adjustment, okay, in the table, okay, you are going to look at this item. Okay, and then lastly, you have to total up the cash flow for every year. Okay, for each year. Uh, After you prepare the table for cash flow, okay, from year 0 until last year, I mean at the end of project life, okay, basically the question will ask you to calculate NPV, okay, NPV or IRR, okay, IRR. So for this question, you will need a financial calculator to calculate NPV and IRR. Okay. So far, any question?
Sir,
Hmm?
ada yang terdapat masuk kelas.
Masuk?
Dekat grup WhatsApp.
Okay, dah.
Okay.
Okay, thank you.
Silakan, sir.
So far, any question?
No, sir.
Tak ada. So, kita cuba buat soalan. Okay. Stop dah orang azan. Boleh?
Boleh, sir.
Boleh, sir.
Okay, orang azan Okay. Okay, welcome back. Dengar tak?
Dengar, sir.
Okay, boleh tengok soalan yang saya share ni.
Boleh, sir.
Okay, can someone please read for us? Hafizah.
Saya, sir.
Tolong baca jap.
A project required an initial fixed asset investment of 300,000 depreciates on a straight line basis to a zero value over the 3 years life of the project. The after-tax value of the fixed assets at the end of the project is estimated to be 35,750. Projected sales volume for year 1, 2 and 3 are 6,500 units. 800, 500 units and 10,200 units respectively. The sales price is estimated to be 18 per unit for the first 2 years and reduced by 5% for the following 3 years.
Okay,
40
jap. Ada error kat situ. Okay, projek itu hanya 3 tahun je.
Okay.
Okay, yang 5% tu, yang reduced by 5% for year 3.
It's
Okay.
5% for year 3.
You tolong betulkan. Okay, bukan following 3 years. For year 3
Only, sir.
sebab projek hanya 3 tahun je.
Okay.
Okay. Proceed.
Okay, saya sambung. 45,500 initial investment
41 kan?
41,500 initial investment in net working capital NWC is required.
Okay,
With
this
additional
is required bukan reduce. Okay. Continue.
which additional NWC for year 1, 2 and 3 at 47,500,000 at 550 and 67,450 respectively. Variable costs are 45 ringgit per unit and fixed costs are 70,000 per year. The company has a tax rate of 28% and a required return on investment of 10%. Construct the relevant cash flow of the 3 years proposed project.
Okay, thank you.
Okay, so thank you.
Okay, this project only take 3 years. Okay. So now we have to prepare the cash flow table. Okay, I show you. You just prepare a table. Yeah. Okay. In the meantime, you please take note of the important figures here. Okay. For example, fixed asset cost 300,000. Okay. We just jot down. Okay. You list out kat bawah tu. Okay. While I prepare the table. Okay. Boleh? Okay, kalau you ada soalan nak tanya pasal information dalam question tu, bertanya. Okay, can you see the table?
Yes, sir.
Okay, I want you to prepare a table like this. Okay, we have 4 column. Okay, for 3 years. Start with year 0. Okay, the initial year. Then year 1, 2, and year 3. And then we have one column here. We have for OCF, okay, operating cash flow. And then we have ATSV, after tax service value. And then we have net working capital required and net working capital recovered. Okay, and then the last row we have total cash flow. Okay, for every year. Okay, have you prepared the table?
1 minute, sir. 1 minute, sir.
Okay, okay. Done. Siap.
Done, sir.
Okay, first we'll calculate annual depreciation. Okay, you take the cost of fixed asset. How much? Cost of fixed asset? Hello? 300,000 kan?
300,000.
300,000. Okay, 300,000 divided by number of project life. Number of years. How many years project life? 3 years kan?
3 years.
Okay, so how much? 100,000 kan? Okay. Okay, after that you calculate operating cash flow. Okay, for every year. For every year. Okay, you can use either top-down approach or tax shield approach. Okay, up to you. Because any approach will give you the same answer. Okay, for example, here I use tax shield approach. Okay, up to you if you want to use top-down approach. Okay, but I use tax shield. Okay, so first item is Q. Okay, how many unit for this for year 1? How many? $6,500 kan?
Betul.
Okay, 6,500. Okay, and then you find P minus VC. P minus VC. Okay, how much the sale price? 80 M for year 1. Okay, year 1 and year 2 eh? Okay, 80. 80. And then minus variable cost. How much variable cost? 55. Okay. Minus 45. Then you minus fixed cost. How much fixed cost? How much fixed cost?
Fixed cost.
70,000 kan?
Oh.
Okay, 70,000. Okay, and then close bracket. The time 1 minus tax. How many percent tax rate? 28. So you minus 0.28. Okay. And lastly, you plus depreciation. Okay. Time. Tax rate. Okay. I put note here. I use tax sheet. If you want to use top down, it's okay. 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 And tax rate. Okay. Well, how much OCF for year 1?